Hello, everyone. My name is Brittany Button, and I'm a long-term care insurance specialist at Art Jetter and Company. Thank you for joining us on this highly anticipated presentation from Mutual of Omaha. We are joined by Stephen Alloy, Advanced Markets Specialist from Mutual of Omaha. Now, we will discuss the tax benefits that come with the purchase of long-term care insurance. Before I turn it over to Stephen, I just want to mention that if you have any questions throughout the presentation, you may type those into the chat or questions box on your screen. Those questions will be answered at the end of our presentation. Also, we have some handouts available for you to download. One is an overall tax guide for your reference. The other two pieces are consumer approved, which can be a great resource to share with your clients and others in your network. So without further delay, Stephen, let's get going.
Hey, thank you, Brittany, and thanks everybody for calling in today or joining the call today. We're going to, as Brittany mentioned, we're going to talk about the tax benefits of long-term care insurance. And, of course, there are a lot of good reasons to have long-term care insurance beyond the taxes, but there are some good tax benefits to them as well, even while you're owning the policy and before you go on to claim. Obviously, you go on claim, the benefits are tax-free, and we'll talk a little bit about that. But there are some great tax benefits that go along the way as well that I think, making these clear to individuals could help them see the value maybe to getting long-term care in place. Long-term care insurance, as I'm sure you're probably all aware, is treated as basically is taxed and treated as health insurance, accident and health insurance. This is all because of the HIPAA Act that's been around for quite a few years here, and policies such as ours and really all the standalone long-term care policies, all the ones that are being currently issued that I'm aware of at least, are in compliance with that and our HIPAA standard policies. So probably the first tax benefit that people like to talk about with long-term care insurance is deductibility of the premiums. And short answer is yes, you can deduct the premiums. How they're deducted and when they're deducted, and also how much you can deduct, depends on who the person is, who the taxpayer is. It's different for individuals and businesses and employees. And actually within businesses, there are two types of businesses. There's a C corporation, there's everybody else. So we'll go through these one by one. Before we get into those though, a term that's going to come up particularly in the deductibility is eligible premiums. Now, these are the numbers that the IRS issues each year that are that depending on the category that you're in when you try to deduct the premiums, you may be limited to the eligible premium. So as you can see, it's age-based. It goes up basically every decade. The ones on the left are the numbers for people doing their taxes here that are, due fairly soon. Yeah, well, sooner than we would like here. In about a month or so, they're going to be due. So those are the numbers for the 2023 taxes. The numbers on the right are the numbers for this year, for planning for this year. You can see that numbers went down. A lot of people ask me why. I wish I had a good answer. I don't really know why they went down, but I don't think the cost went down, but nonetheless, the eligible premium went down a little bit this year. So those are the numbers, and those are in the handouts that Brittany had talked about at the beginning. Those numbers are in there. So let's start with the individuals, because probably most people buying long-term care buy it as individuals. So an individual can deduct the premiums, but the way they deduct them is that they're considered a medical expense, an out-of-pocket unreimbursed medical expense. And the premiums would be added to all other out-of-pocket medical expenses. And to the extent that that total was over 7.5% of the taxpayer's adjusted gross income, they can deduct anything above that. So they would have to reach that 7.5% threshold first, and then anything over that would be deductible. The only way that an individual can deduct it, though, is they would have to itemize their deductions on Schedule A. And again, they are limited. The amount that they can claim they're limited to the eligible premium. It'd be the actual premium up to the eligible. So if your actual premium is lower than the eligible, you get the actual. But if your actual premium is higher than the eligible, you'd only be able to claim the eligible on the Schedule A to itemize the deductions. Now, unfortunately, a lot of people don't see that because most people, even before the Tax Act of 2017, I think most people probably took the standard deduction, or a lot of people did. After that tax bill, that basically doubled the standard deduction. So now the standard deduction is taken by, well, the Joint Committee on Taxation says 9 and 10. I think that's only because there's not a number between 9 and 10. I think it's more than 9. It's obviously less than 100%, but I think it's more than 90% take the standard deduction. Now, that is scheduled to sunset at the end of 2025. Hard to say if it actually will. I think a lot of the stuff in that Tax Act is going to sunset. I don't know that this is going to be one of them. I think some of the things may not sunset. So I guess we'll have to wait and see. But with that higher standard deduction, even fewer people itemize. So not itemizing, as one way to look at it is you're taking, if the standard deduction is a better deduction, you're basically getting the effect of deducting the premiums, but you're not itemizing. So you're not literally deducting them, but if that's a better deduction, well, yeah, you should take the standard if that's the better deduction. So that's why a lot of individuals maybe don't see the deductibility of them, but it is there. Businesses, as I mentioned, there are two different types of businesses. There's essentially C corporations and everybody else. Everybody else is considered self-employed, even if they, like LLCs and S corps and everything, they're considered self-employed. So let's take a look at the self-employed first. Again, sole proprietors, LLCs, S corps, greater than 2% shareholders of S corps. They are treated as self-employed, and for self-employed individuals, they can deduct the eligible premium without needing to meet that 7.5% threshold. So the way they would deduct it, they would deduct up to the eligible premium. Again, if their actual is lower than the eligible, they'd get the actual. If it's higher, they'd get the eligible. But they can actually deduct that on their business tax return, on line 17 of their business tax return, and then carry that over to their own personal return. So the nice thing about that is for business owners, for quote unquote self-employed business owners, they get that deduction even if that's their only medical expense. It's pretty unlikely really to be their only medical expense, but if it is, they would still get the deduction. They don't have to meet any 7.5% criteria or any threshold. They would just automatically be able to take that deduction. C corporations, it's a little bit different. It's actually in some ways a little bit better. It applies to shareholders who are employees, so wouldn't apply to an absentee owner of a C corp, but it would apply to that shareholders and employee and any spouse and dependents of that shareholder employee. So with a C corp, the deduction is the actual premium. Even if it's higher than the eligible premium, they can deduct the actual premium. So I think when you run across C corps, and you probably aren't going to run across a lot of them. Most of the companies that you're talking to are probably going to be S corps or LLCs. But when you do run across a C corp, long-term care should be one of the first things you think of, because the deduction is pretty good, and you can design a great plan and get it fully deducted with a C corp. So one of the nice things about long-term care is that it can be carved out. You can do it exclusive. You can do selective benefits with long-term care that maybe aren't available with some of the other ERISA-related products. So employers can carve out a class of employees and offer long-term care to them, and they're not required to offer it to everyone else. Now, having said that, a company that wants to do that really should work with their own attorneys to make sure that they are complying with all applicable state and federal laws. Don't want to run afoul of any of those, and then either have the plan invalidated, or you've got to include everybody. So they should work with counsel to make sure that they're doing it the right way. But assuming they do it the right way, yes, they can carve out certain employees that will get the long-term care benefit. So tax treatment for employees. Now, this is, in a lot of ways, this is the best of the three. Yeah, this is kind of the tax trifecta here. It really, I don't think taxes get any better than this. The business can deduct the actual premiums, and this is not for owners. This is for employees. So if someone's just an employee, has no ownership in the company, and the company provides long-term care, the company can deduct the actual premium for that employee and for the employee's spouse and dependents. Even if it's higher than the eligible premium. The employee is not required to include those amounts in their income. So it's unlike if you have worked with, say, executive bonus and life insurance, that yes, the company can deduct the premium, but then the premium is added to the employee's income. Not the case with long-term care, because it's treated as health insurance. So the employee is not required to include it in income. And then, of course, the benefits are tax-free when received. So typically no out-of-pocket on the coverage, tax-free benefits. Really didn't get a whole lot better than that. That's a pretty good deal from a tax standpoint. So certainly if you've got employers that are looking to cover employees, it's not only a great tax situation for everybody involved, but it's also a really good benefit. It's a benefit that I think might have a unique appeal to a lot of employees. So it's, I guess, something to keep in mind as well. As I mentioned, the benefits generally are tax-free, but of course there's a little caveat with that, and an asterisk perhaps next to tax-free. They're tax-free to the extent that they don't exceed the actual expenses. If it's a reimbursement policy, or if you have an indemnity policy, as long as it doesn't exceed the per diem amount, which is, again, went down a little bit in 2020 for 2024, but looking at 2023 for those doing the 2023 taxes, is $420 per day. So that works out, that's around 130 something, 140,000 for the year. So as long as the benefits didn't exceed that, they would still be tax-free. To the extent they do exceed that, however, anything above that would be taxable. So some other tax considerations, some of the questions we get periodically, can you pay long-term care premiums from a health savings account? Yes, you can. Sometimes we get questions from a medical savings account. That works too. Yes, you can. Can you pay them from a health reimbursement account? The answer again is yes. So that's some pretty good answers, pretty good news. Now, unfortunately, the news doesn't stay quite so good. We sometimes ask, can you pay them from a flexible savings account or a cafeteria plan, sometimes called a 125 because it's section 125 of the tax code? No, unfortunately, you can't from those because of the tax benefits of going into those plans. So no, unfortunately, you can't. But from health savings accounts, medical savings accounts, yes, you can. Now, technically and legally, you can do a 1035 exchange from a life or annuity contract into a standalone long-term care policy. This was made possible by the Pension Protection Act, which became effective, I want to say, in 2009. Now, just because you legally can do it doesn't mean that you would be able to do it, unfortunately, because most carriers won't do this. One of the reason being that unless absent a single pay long-term care, which we don't have anymore, there aren't too many out there, I don't think. absent a single pay long-term care, it's not clear from a tax standpoint, it's not clear if an ongoing, a lifetime 1035 still counts as a tax-free exchange. Typically, it's a one-time. Now, you can do a partial on annuities, but it's not clear if an ongoing lifetime pay, if that still counts as a 1035. So the law allows it, but it's very, very difficult to actually do it. Now, one workaround, it's not quite a 1035, but it is a way of effectively doing the same thing. It's not totally tax-free though. One way to do this would be to do a 1035 from a life or annuity contract into a SPIA, and then you use those SPIA payments to pay the long-term care premiums. That still works, and that's not technically a 1035. So yes, you can do that, and we can do that with you as well. A little bit of the SPIA payment, depending on their age, some of the SPIA payment is going to be taxable. So it's not quite as good as a 1035, but it's something that it's a workaround. It's something that can be done where most carriers won't allow a 1035 into a lifetime pay long-term care policy. So sometimes we get asked questions about return of premium. And return of premium, if someone didn't deduct their long-term care premiums, the return on the premium is tax-free. However, if somebody deducted it, then the return of premium is taxable to the extent it was deducted. So this could be the one ray of sunshine in the higher standard deduction, where people aren't specifically deducting their long-term care premiums. Somebody that's doing that and has return of premium, okay, well, you didn't take a deduction for your long-term care premium. That's going to be a tax-free return of principal. So, that's the one bright spot of not specifically deducting it, perhaps. But anything above, or anything to the extent that they had deducted the premiums, anything that was deducted to that extent would be taxable with the return of premium. Now, sometimes we get asked questions about gifting, medical gifting. And of course, the gifting limits, there's an annual gifting limit, there's a lifetime gifting limit. But for medical care, there's an exception. There's an exclusion from that, where you're not limited by this year 18,000 annual gifting limit or the lifetime gifting limit. The medical care gifting, the cost of medical care is unlimited as long as it's paid directly to the provider. So you can gift any amount. If you're actually gifting to the medical facility, you can gift any amount. It would have to be paid directly to them, not to the individual. And if for gifting of long-term care premiums, it's unlimited. It's sort of unlimited. It's unlimited, but it's not really unlimited, because you're actually only able to gift up to the eligible premium. So again, if your actual premium is lower than the eligible, you're fine gifting all of that. If it's above the eligible, some of that would count against the annual. Anything above the eligible would count against the annual gifting or the lifetime gifting. So, there is that consideration, but in general, that can be done, and depending on the amount of the premium, it might be completely covered by the gifting. A lot of states, in addition, we've talked primarily about federal tax benefits here, but a lot of states have some pretty nice state benefits and state incentives for doing long-term care. And typically these are states that have state income tax, because that's usually how the credits come in, or how the tax benefits come in on the state level. Can't go through every state, but again, some states have some pretty nice incentives, because they're looking at their Medicaid costs, and they want people to have long-term care insurance, so they're giving some tax benefits as an incentive to do that. I would suggest checking with LTCI, the American Association of Long-Term Care Insurance. They have chart of each state and what the benefits are, so you can check for your individual states. I mean, some states it's quite good. It's quite good benefit. Speaking of states and speaking of their Medicaid burden, um, a lot of states, I'm sure everyone knows, if you've been in the industry even a couple of years, I'm sure everyone knows about the Washington State Long-Term Care Program, the WACARES Act, and they have started collecting the payroll tax on that the middle of last year, basically. A lot of states are looking at doing the same thing. And I think because of that, I think that creates an opportunity really for long-term care. Now, it's not, I don't think anything's going to happen in the next few weeks, really probably even this year, for a variety of reasons, chief among them being an election year. I don't think a lot of people are going to start doing this, until at least after the election. But I think a lot of states are very close to introducing bills. There is a bill actually pending it's in committee in New York, and everybody's kind of watching California because the actuaries have returned their recommendations, and I think I'm not expecting anything in California this year as far as legislation. I mean, there'll be more talk about it, but I don't think there's going to be legislation this year because of the election year and because of they suddenly have a much bigger debt than they were expecting they were going to have. So I don't think that's probably going to fly this year, but starting next year, we could start to see some things come out of California and some of the other states as well. So I guess what that means is that the next couple of years could be a great time to get some long-term care in place, and to the extent that people can opt out from these the payroll taxes that a lot of these programs are prescribing as a way of paying for the program. To the extent there's a way to opt out of that, they would be able to opt out, and even more importantly than really opting out of the tax, they'd have good coverage because if you've been following the WACARES, you know that the benefits are pretty small, pretty limited with the WACARES Act. So people getting good coverage and being able to opt out of that program, I think is it's a good thing. It's worth doing. So I would, I'd suggest I really think the next couple of years is a way of, it's a good opportunity to get that word out. And, one of the problems that I think, or one of the challenges out there in selling anything is if somebody doesn't see a need, everything's too expensive if you don't think you need it. Well, this might start changing some of that thinking. Is saying, well, hey, maybe I do need it, and maybe I'm going to get it from the state, whether I think I need it or not. Maybe we're going to get one of these. And if that happens, wouldn't I rather have one that I know is going to be the benefits that I really need, rather than $36,500 lifetime benefit? I mean, it's not going to take you too far if you really need care. So I think we've really got a good opportunity here the next few years to tell the story about long-term care and really get the word out there. One thing, Secure 2.0 actually had one thing. Most of it had nothing to do with long-term care. It was primarily retirement accounts, but it did have one thing that could be an interesting development in the long-term care field. Depending on who you talk to, some people think it won't be that big a deal, but some people think, well, maybe it will. Beginning at the end of next year, 2025, a retirement plan would be able to distribute up to $2,500 per year for, the way the act reads, certain LTCI premiums. I think that's just, I think the policies that we have and that really most carriers that are in the industry have probably qualify. So they haven't really specified what they mean by certain LTCI premiums, but I think that's what they mean. The policies that we have out there. The distributions it would be a taxable distribution, but it's exempt from the 10% penalty. So you could have somebody younger than 59 and a half take money out of a 401k, for example, and use that to pay for long-term care. Policies have to provide high quality coverage. Again, they haven't really provided guidance on what that means, but I got to think that if a policy is HIPAA compliant, is part of the partnership, I think the policies that are out there, I think are what they're talking about here with high quality coverage. Some people have said that this probably won't be that big a deal because most people that buy long-term care are not that much younger than 59 and a half. But on the other hand, I'm thinking, and some others are, maybe thinking this direction as well. Two thoughts. Well, even if they're 52, they still have 7 or 8 years of this, that they could take advantage of this. And secondly, maybe this would be a factor in getting the average age of people buying long-term care a little bit younger. Because obviously, if they buy it younger, premiums are going to be lower. So, maybe this could be an incentive to people in their 40s still to start looking at long-term care. So remains to be seen, but that's an interesting development. A little over a year and a half from now, we'll have a chance to see how that works. So there's actually another great tax benefit with retirement accounts. It's limited to retired public safety employees. So to the extent you have any of them as clients, it's a great benefit. I mean, it doesn't apply to anybody else, but if you have, say, retired police, firefighters, EMTs, ambulance crews, things like that, they can take up to $3,000 from their plan and use it to purchase long-term care. It does have to be paid directly to the carrier. And again, kind of remains to be seen from the 401k, from the Secure 2.0, that may have to go directly to the carrier as well. But this does have to be paid directly to the carrier. But if you've got these clients, it's a nice benefit. It's a nice little benefit. I'm not going to spend a lot of time with the partnership program because you're probably well familiar with that. I think all long-term care is asset protection because, if you think about it, if you need care, there are only a couple ways you can pay for it: yourself or with insurance, right? I mean, those are basically the ways. And so if you're paying for it yourself, that probably means you're going to liquidate assets. And of course, liquidating assets, you're probably going to trigger taxation. So you're going to have to liquidate even more to get a net amount that you need. So, and that becomes kind of a slippery slope at some point. You keep, and then you take more, and then, it's even a higher taxable amount. So you've got to maybe take even a little bit more. So I think all long-term care really is asset protection because it means you don't have to do that. You don't have to spend down your assets. But the partnership program is literally asset protection. And I'm sure you're familiar, every dollar of the long-term care benefits exempts that from a Medicaid spend down. So you could still qualify for Medicaid if necessary after spending the long-term care benefits, but you'd be able to withhold or protect, exempt assets that included the benefits that were paid via long-term care insurance. So nice program. And again, it's kind of highlighting the asset protection nature of long-term care, I think. So with that, didn't mean to go quite that far. With that, certainly there may be some questions, but obviously if you need assistance or you need any help or anything, you're working with some great people. I'd give Brittany a call and they'll be able to help you out. So Brittany, I don't know if we have any questions, but we got maybe a few minutes here. I'd be glad to answer any that there are.
Yeah, and we did get a couple of questions. Now, this one I'll have you readdress. I know you had made this comment at the beginning of the presentation. We did have some late arrivals. The first question that came through is, do you know why in 2024 those tax deductibility limits went down?
That's a great question, and short answer is no, I don't. I have no. I'm not sure why. In a time where I'm pretty sure, I haven't gone out and priced it, but I'm pretty sure the cost of care didn't go down. So I'm not sure why that went down, but there it is. I know it went up quite a bit in 2023. So that it may be a way of saying, oh, we went up too much. We thought, it was because it was higher inflation at the beginning of 2023 than it was at the end of 2023. So well, we went up too much. It might be a way of balancing it, but that I'm speculating on that. I don't actually know why it went down.
Yeah, and I have yet to find any articles that address the reasoning why as well. But I don't know about you, Stephen. It took me by surprise. I figured if anything, they'd keep it level or flat, not decrease it. But thankfully, that decrease wasn't a whole heck of a lot. So
it wasn't
still
really
definitely
big.
has its benefits there. Yeah.
Oh, yeah.
All right, and then we've got one more question. Oh, nope, I see a few people typing. So next question up here is, and I can help tackle this, and Stephen, if you have comments as well, is we've got folks asking about these hybrid long-term care life policies or life insurance with LTC riders. Now, yes, they can hold the same tax deductibility benefits. Kind of a general broad overview is you want to make sure it's a 7702B product and that the insurance carrier is breaking out the premium between the life insurance component and pricing and the long-term care components and rider. The cost associated with the long-term care segment, same rules apply. So that's kind of my 10,000-foot view to keep it short and simple. Stephen, any comments you'd like to add?
Well, I would agree with that. I think that is a critical factor to find out if it is a 7702 rider, because most, I hate to generalize like this, but I think most carriers are kind of like ours, and the cost of the rider is paid just from insurance cash value. It's not broken out separately, and it's therefore not deductible. Now it does count as if there's an opt-out, if there's a state program and there's an opt-out, those riders did count in the state of Washington, so presumably they would count in other states. So that's good. But as far as deductibility, we some do. Some life policies do break it out separately, but I think the majority don't. So it's got to be careful taking a look at that.
Yeah. And typically you'll find that on illustration. So I know a couple of the questions coming through are very, it seems like case specific. Those asking those questions will be reaching out to you after the presentation just to respect everybody's time. Now, for those of you that have joined, you will get a replay link from GoToWebinar of this session. So keep an eye about that. I think it sends about an hour after we wrap up here. Last question before we let y'all go, though. And Steve, I don't know if you want to tackle this. I definitely have some comments, but the question is, if premiums are from a qualified account, are the benefits taxable?
Well, my understanding is that, and I hear about things like this, but my understanding is that if you're going to use qualified money, that it would have to be, you'd have to take a distribution and then it'd be a taxable distribution and then pay the premiums. If you did that, then you could deduct, assuming you itemized, you could deduct the premiums, or if it's a business, could deduct the premiums. But you'd have to take that taxable distribution first. So it might be about a wash. It might not even be a wash. It might be a little behind on that.
And exactly, I completely agree. You're going to find there's quite a few carriers out there with 7702B products that simply won't accept qualified funds. They do want it from a non-qualified source. So that's where Stephen's coming in, where, well, it's probably a taxable distribution. Uncle Sam wants his cut. There's no loopholes yet. I've heard legislation may be in the work to maybe avoid some penalties there in the future. Of course, we'll let you all know if that does come to fruition. Now, there is a specific product we work with on the hybrid side where we can transfer in qualified funds, but same concept. They're going to do an internal distribution over 10 years, turning the qualified funds into non-qualified. Because once it's non-qualified funds, in the 7702B policy, yes, you've got tax-free benefits, but
Ah,
unfortunately, there's no way to tax defer qualified funds and get those benefits out tax-free.
right.
Unfortunately, that's just too good to be true uh,
Hmm.
for the current time being.
Yeah. And that Secure 2.0, the 2500, maybe that's a start, a first drop in the
Yeah.
bucket, and maybe someday they will say, if we really really want to incent people to buy long-term care, let's let them move the money direct. Well, it'd be a wonderful change, but that's not how it is now, unfortunately.
Correct. And we actually, on one of my study groups, we just had this conversation. Just so many folks are qualified funds rich.
Oh
They're in
yeah, yeah.
401ks, they're in
Hmm.
IRAs. And I think eventually, well, perfect world, I guess, the government has to address it at some point
Hmm.
because
Yeah.
they know people are in need of care. These states are coming up with these long term care state programs. So
Hmm.
it's just going to be another nugget. Hopefully, that can be some type of solution down the road. I like to be
Yeah.
optimistic. We can
Yeah.
hope.
And I would, in fact, I actually was presenting on some of the state-based plans a couple of weeks ago, and good question came up that, and I started thinking about it. Yeah, the question was, well, hey, with a lot of states doing different things, do you think the federal government is going to come in at some point and try to standardize it? And maybe, and if they do, well, then maybe we
Yeah.
could get some of these tax breaks that, because states are, pretty much not able to give you federal tax breaks, but the feds could. So, so who knows? That
Well,
might
eggs.
state program might actually lead to something good. Who knows?
Well, and I know both Stephen, myself, and probably every long-term care specialist out there, we are keeping a close eye on these states. The
Hmm.
New
Oh
York
yeah.
legislation looking awfully familiar to the state of
Oh yeah.
Washington and their
Yeah.
Washington WA Cares Acts.
Hmm. Yeah.
California, we know they've put together their task force and looking to do the same
Hmm.
with a handful of other states
Yep.
where it's kind of whispers and rumors and something
Yeah.
may happen. So again,
Hmm.
you all on the call, when we find out more about these states and where they're at in these processes of passing legislation, our team's going to let you know. So right
Yeah.
now, it's just
Mhm.
a lot of what ifs.
Right. Right. I think we're in, and probably for the next, well, certainly this year and probably part of next year, I think we're in that, hey, what if we do this? What if we do that phase? But in a way,
Yep.
that's good because that gives us more time. It's not like something's coming next month. No, I mean, they probably got a good year, maybe more, so I don't know, plenty of time, I guess, to get it done.
Exactly. All right. Well, we're going to let you all go. So first, I want to say thank you, Stephen, today,
Oh,
as
thank you.
well as everyone who joined us. Of course, we encourage all of you to start thinking about people and business owners that could benefit from this opportunity. So, our team is standing by if there are any further questions or you didn't have a chance to download those materials. Contact information is on the slide. For those of you who did ask questions and we didn't get those addressed on the call today, again, we'll be reaching out to you individually. So, again, thank you, everyone, and enjoy the rest of your day.
All right, thanks.